This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So we went through and finished that last video off, didn't we, by looking at the recognition criteria within the framework. Now, the recognition criteria were there that we had to have a probable outflow or probable inflow of economic benefit, and we needed to be able to measure that element reliably. Now, if we're being told to measure it reliably, then surely we need something to help us with the measurement. And we do here, that we have our 4 measurement bases that we have within the framework that will then be applied in all of the different accounting standards that we then see in the later videos. Okay. And some of them, most of them, you've dealt with before. Okay. If we think about property, plant and equipment, you go through there, you capitalize it at cost, and then you depreciate it. Okay, so that is an example of your historic cost, because you bought it historically at whatever it costs, and then you decide to depreciate it over its useful life down to its residual value. Okay. Maybe we can go through there and look at your current cost. So what is the fair value of that asset at a particular point in time? So as we use that asset over time, maybe if we had 10 years, after 2 years, there's 8 years left on the asset. Well, what's a 2-year-old asset worth? Okay, if it has 8 years left, what's its fair value? What are people prepared to pay for that asset in its current condition? Okay, so that's your current cost in terms of your revaluation model, isn't it? What about your realizable value? Well, we've looked at inventory, the law of cost, and NRV. So the cost is the historical cost. The realizable value is effectively looking at what you can sell it for less any cost to sell. Okay. And then you've got your present value. So we will go through there and look at valuing potentially under fair value accounting, looking at the cash flows that this asset generates and then discounting that back to present value. To go through there and give us maybe, as when we look at impairment, a value in use. If we use that asset, it's going to generate us cash flows. And if we know what those cash flows are and what the level of risk is attached and the return that's required, we can discount them back at an appropriate level, can't we? Or an appropriate discount rate. So we just go through and just have a play around with some of the numbers. Now, if we go through there and think about your historic cost. Imagine you go through there and buy an asset. So the asset that we have has a cost initially, let's just say is it of 200,000, and we bought that there on the 1st of January X1. Let's just say that its life is 10 years, isn't it? So therefore what we have is the depreciation is $20,000 per annum, isn't it? So if we're to go through that and work out the carrying value at, say, the 31st of December X2, so is that 2 years down the line, we'll have charged, is it 20,000 in X1, 20,000 in X2. So the carrying value of my asset under the historic cost convention is there as 160,000, isn't it? Okay. Is that okay? Yeah, it's fine. What happens, however, let's just say that if we're looking at your current cost. So current cost, we are looking here at an asset, say there, is it at fair value? And let's just say there that the fair value after 2 years is £280,000. That's what someone would be prepared to pay for this item of property, plant and equipment on the 31st of December 20x2. Okay. So you've got a 2-year-old asset. We've depreciated it down to, is it 160,000? If we're using current cost accounting, so effectively your evaluation model, we revalue it to fair value. So therefore your carrying value at that date of the 31st of December x2 is there as 180,000. And again, what you've got now is you've got the position rights in terms of your statement of financial position value. So you can then look at the movement from what it was held at previously to now its fair value, and that will go through there and look at the changes in this economic resource, won't it? Okay. Just note, when you're looking there, is it at this current cost and your evaluation? That's normally for an asset that is not specialised in nature. Okay, it's just a normal day-to-day asset that in normal everyday use. However, we just need to go through there and add in or look at another measurement basis linked to your current cost, because we could also go through there and use, is it your replacement cost? And this is what we use if the asset is specialised in nature. Okay, if it's specialised, there tends not to exist a fair value because it's so specialised that only you go through there and use it, and therefore nobody else is prepared to go through and buy it from you. Okay, it's that specialised in nature. So what we go through and do there, might just need to edit that out. Hopefully we'll get through this before it all breaks. So what we go through and do there is we look at what its cost would be today. If I was to go through there and manufacture or make that cost, then your cost previously under historic cost was 200,000 the 1st of Jan x2. The cost today, so we're looking at the values in the financial statements on the 31st of December x2. The cost today to construct or to make that specialised asset would be 250,000. Again, it's the same asset that we bought 2 years ago, so it would still have the same life, which is there as 10 years. So if that's the case, the depreciation that we would be charging is $25,000 per annum. So what we need to look at there is say, well, look, we can replace this asset with one that's $250,000, but it's comparable to an asset that's been used for 2 years and therefore has 8 years left. So if we'd have gone through there and replaced it, what would be its depreciated replacement cost? So its carrying value at the 31st of December x2. We know that it would cost me 250,000 to replace today, but we need to compare it on a like-for-like basis to make it comparable to the asset that we are currently looking to value. The asset is 2 years old, so there's 2 years of depreciation that would have been charged. So under this depreciated replacement cost, the carrying value is there at $200,000. Okay, being the 250,000 less 2 years of depreciation at $25,000 per annum each year. Okay. You then also got the, is it your realisable value? So effectively to you or I, you've got your current cost, which takes account of your fair value. Your realisable value is looking at your net realisable value. So here what you've got there is that your fair value is at 180,000. So is that there at my 31st of December X2 reporting date. And then what we have there for this asset is that maybe there's some selling costs. Shall we keep it simple? Of 10,000. Okay, so that might be cost to dismantle it, to transport it, whatever it may be, in order to sell it. So if that's the case, the carrying value of the asset at the 31st of December X2 is equal to $170,000. Okay. There we go. The other option that we've got to measure the value of this asset, this value of property, plant and equipment, is to go through there and use your present value. So effectively that's your discounted future cash flows. So what you've got there is that if your cash flows are equal to, is it say $28,000 per annum, we'll keep it simple there. We'll say that they are the same for the following 8 years. You know, this asset has got a 10-year life. 2 years have gone, so there's only 8 left. Let's just say that your discount rate is 5%. So if you've got a discount rate of 5%, I'm not going to get all financial management on you, but an annuity factor of 1 to 8 at 5%, I'm led to believe, is it there at 6.463. Try and work it out yourselves. Look it up on the tables. You can tell me if I've done it wrong. Okay, you're all very useful at helping me know where I've gone wrong. Okay, I have no one here to help me check, so you are my eyes and ears. Okay, so if I can find my calculator, I don't seem to be able to find it. One moment. There we go. I found it. So what you've got there is to work out the carrying value using your present value techniques at the 31st of December X2. You take the 28,000 and multiply it by 6.463, which gives me there is it 180,964. So to you and I, $181,000, give or take a little bit of rounding, isn't it? And what you've got now is if you go through there and look at those 4 different measurement techniques, going back to your first one is your historic cost. So you've got there, is it 160,000? That's what we would show on our financial statements there. If we adopted the revaluation model, then we would revalue it up to the 180,000 at December X2, and then the movement would go to other comprehensive income. If the asset was specialised in nature, then there would be no fair value that would exist. It would be very difficult to go through there and find it because the asset is so specialised, only you can use it, so no one would be willing to pay to buy it from you. So you look at your depreciated replacement cost, which gives you, is it there, 200,000. Your realisable value, it is taking that fair value, isn't it, and deducting the cost to sell, which gives you the carrying value of 170. And then you've got there your present value that takes the cash flows, looks at how many years you have left to use this asset and discounts them back at an appropriate discount rate. Okay. So they are the different measurement techniques. You might have to apply them within the exam in terms of measuring a financial asset, a financial liability, or just a normal asset or liability. Let's not get too carried away with financial instruments just at this point in time. But you could also be given an example, an illustration, and then that be part of a multiple choice question and say, which of the following measurement techniques is this scenario identifying with? Okay, there we go. Excellent. So that's it at that point in time. I think we're going to go through there and have a look, is it later on, at some capital maintenance.